The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello and welcome to today's Become a Pro course here at Forex.Academy. I am, of course, your host, Robert Blackwell, and have the pleasure to walk you through today's lesson. Today we will be discussing an approach to professional trading, with lesson 2. Just before we begin, please do take a moment to read through the following disclaimer. Note the financial risk is involved in trading the financial markets. And just a few pieces of housekeeping before we do begin, of course. Feel free to ask questions throughout. It is an interactive live webinar, so do make use of the live education. You can ask questions as we go through some of the slides and presentations. We'll go onto the trading platform at times as well. Or if you prefer to hold off on your questions to the end, you can certainly do so. So you have the chat box there located on the right-hand side of the screen that you can input your questions to. This live webinar is being recorded and will be placed into your members login area once we have concluded. If you could just give us a 1-hour grace period, of course, for revision, we will upload that for full revision purposes. And of course, we'll have a Q&A session to deal with any questions there at the end of the webinar. Just to consult the timetable, of course, we are in the second lesson here, just in the first week of the course. We have a full month of education to look forward to. It is more of a professional context in which we look to trade and build upon our retail trading skills in approaching these financial markets. So it is a lot of education to take in, and I do hope, of course, you do enjoy it. In terms of this webinar, of course, we are now on to webinar 2, an approach to professional trading. We have covered the main overview of the Become a Pro course. So we have a lot to look forward to, of course. In today's particular webinar, we will be discussing a retail versus professional trading, not just only in attitudes, but in terms of practice. So that builds upon different professional principles and the account practice and your own thoughts to trading in your own live account, and proper dissemination of information in terms of understanding more context, gaining more education, guys. Of course, all professionals would agree that financial trading is a pursuit. It's an ongoing pursuit of education and adaptability as these markets move every single day. A new news flow becomes available to the markets, and obviously price action resulting to move from that. So we'll start to build upon our experience as retail traders and really start to flesh out our knowledge, our experience, and get involved much more heavily in professional trading attitude. And of course, for the week ahead, we have effective market analysis to look forward to, and the macroeconomy, which will really build upon our economics skills of financial markets. So let's delve into today's lesson and discuss building a professional methodology. Those who have been profitably trading the markets over a long period of time have needed, of course, to make many adjustments along the way. So we can accept this as a result from day one. Successful traders must adopt trading strategy to suit the current trading environment. As a result, expectations on performance need to be in sync with market volatility and risk sentiment. So there are those traders that thrive on volatility, of course, and they're more susceptible to placing more trades in such an environment, as their skills may dictate that they are obviously more equipped to maybe trade with smaller size, but making various amount of trades. Well, they're going to dictate a level of performance, of course, in terms of this new change or risk sentiment in the environment. Alternatively, you have other traders that defer to a much more structured approach. They like less volatility, they like to take long-term positions, they like to trade with large trade size and maybe have much less trades. So it will be more definite as we go through the Become a Pro course. You will gain an understanding not only of the financial markets, guys, but of yourself, what style of trader you aspire to be, whether you look to scalp the markets, whether you look to swing trade or get more involved heavily in long-term positions. That may be a choice for you. So that being said, trading is not about risk taking, guys. We always talk about the money. It is a lucrative environment, but the money that is involved in financial trading, it's the case, of course. It's certainly not about risk taking. Of course, every trade that you get involved in, you will be assuming some market risk, of course, inherent. But as a practice, guys, financial trading is not about risk taking. It's about ideology, about stacking the odds, probabilities in your favor, and assuming those risks. This ideology is what separates the professional trader from the retail trader. They believe, retail traders more often than not, they see opportunities different. Okay, so when a market is selling off, they think, oh, I can't wait till this stops. I'm going to buy that market. Well, if the market is selling off, there may be a reason for that, of course, and we can get involved with small positions, maybe. We can get involved on the short side, but we don't have a question of value. We look to assess what's happening in a professional method. Okay, no matter the trading environment, professional traders are always comfortable with the amount of risk they have assumed. Okay, so you're starting to deliberate on a level of comfort. Of course, there are times when you will go home at the weekend and perhaps you have too many trades on over the weekend and you'll feel a level of discomfort. That can relate to professional trading, and perhaps we've taken too much trade size or risk. But over the long run, guys, it's not about risk taking. Professional trading methodology is about a law of large numbers. Trading as many trades over the course of the year as possible so that your return on the year or on a monthly basis is a very profitable one. Okay. So let's delve into such more detail in terms of discussing the practicalities of building a professional methodology. Okay, so we define trading style in relation to your own personality. Okay, that's very much the truth. Some people have, more appetite for risk. Some are more risk averse. Some like to get more actively involved in trading the markets. Some less. So let us define it over the next month in terms of our own individuality, our personality. Trading is really no different. Trade selection is very important. Which trades do we select? Which trades are not only good trades in terms of looking at the price action, but what's actually happening in the markets now. To pick a point in time, more currently we have very strong moves in the US dollar. We have very strong moves in the US 10-year bond, treasury bond. It's touching, a yield, an overall yield of 3%. That's starting to cause real concern in terms of attracting investment. And obviously the equities are experiencing a lot of volatility. So we know that's the sentiment. How can we adapt our trade selection to incorporate what's happening and where the volatility, where the opportunity is now in the news flow and in the market sentiment? We define an entry strategy, first of all. So what price do we want perhaps to enter the market at across different asset classes, of course? Why? Of course, is it technical analysis? Is it fundamental? Is it a picture of both? And is it the best opportunity at that particular time? Is it simply that we can't find a great opportunity, so we go for a substitute opportunity that we still think may be good? If that's the case, we can still take that opportunity, but we define an entry strategy much differently. Perhaps you take less risk in that certain sort of circumstances. Proactive and reactive trade management. Okay, so there are two different approaches to such trade management. Are you more proactive? So are you more involved in managing your trade positions, moving your stop losses perhaps on a daily basis, or are you more reactive in terms of watching the news flow, watching the price action, reacting? And again, this is not simply just in terms of being in a trade position. Entering, some people are much, in terms of entry strategy, are much more reactive. They like to scalp. They react instantly to new price action, to new movement, and they like to get involved in that. While others are much more proactive in terms of understanding the constants within the environment, and they trade as such. So there are many different styles to your professional methodology. You can, of course, incorporate them both. Trade expectation and exit strategy again. And then we understand our own expectations with our own personalities in terms of how much risk we assume on each trade. That will have a reflective level of expectation across all markets and on our overall success rate. An exit strategy is of course very important. Where do we exit? Do we simply exit at a monetary value? It depends if we're deciding to run, of course, a positive risk reward ratio or a negative risk reward ratio. Again, it's more structured as an approach to run positive risk reward ratios, But across some markets, like the Forex markets, there are times when you can be more effective with the volatility in running negative risk reward ratios. And again, your exit strategy will counteract with different strategies across your entry. So always focus on what's happening in terms of the environment itself and your own selection, your own trade selection and involvement in trade management. And then of course, risk management, in terms of not only managing the trade, what is the monetary exposure on your account at any given time? What's your whole entire trading exposure? How much are you looking to capitalize on moves? All of these things will come into play, of course, in defining and building your own methodology, a focused methodology to create that path ahead, of course, for consistent trading. So let's move ahead and define trading style, of course. A primary objective for traders now is to define what type of trader they want to be. Okay, that's fine. And of course, the education and some experience, even trading on a demo account, and I would of course advise a live account even as a beginner, but I would assume most of you guys have had retail trading experience, of course, is to define, well, what type of trader am I? What type of trader do I want to be? Do I want to take long-term positions in markets? Do I want to trade the markets every day? Do I want to trade economic news flow like a Forex factory, a continuation of news flow? This decision must take into account each individual trader's personality, skill set, and appetite for risk. Okay, now, that might come across quite obvious, but it's not for many retail traders, unfortunately. If you start to trade and you realize, well, I'm a much better short-term trader, but you want to move across into long-term trading and take larger positions, well, let's take a step back and recognize your skill. First of all, it might suit your personality that you have a skill set, you have a certain level of talent to get involved, and you're assessing whether you're just better at assessing price action or not. That might be the case to trade on a short time basis. So, try and accept these things then, other than, just taking a view of what you'd like to be, and really start to build out your own skill set to suit your personality and your risk, your appetite for risk, of course. While some traders perform better when the markets are intensely volatile, others perform better when the markets see less movement of price. And they can make more structured approaches to decision making, okay? Depending on expertise, traders will supplement their trading strategy with technical analysis and fundamental analysis. And that's always the case. Often the best trading strategies will involve both. And that's, again, if you're a price action specialist, you will choose to ignore, fundamental discussion, of course. That's totally your own prerogative again, but it doesn't mean that you certainly ignore what's happening over the macro economy. Say, for example, if there's a Brexit decision or something, that you're simply going to trade sterling on the day before a huge announcement to the market, you will take, of course, the fundamentals into context. So let's look at trade selection then and ask a few hypothetical questions as we pose ourselves, what type of trader am I? What about trade selection? How do I decide to enter these markets? Well, why am I entering the market? What is this market telling me? Is it, more of a fundamental move, or am I just reacting to price? Why am I entering the market? Does this market provide the best opportunity in time? Okay, is it the best current opportunity? Am I foregoing other opportunities that are quite good just because I favor this market or it's more familiar to me? How much confidence do I have in this trade? Now, of course, it's a total human instinct to have a level of confidence. You should, of course, hypothetically, as you trade these markets, every single trade you take, whether you're a retail trader or a professional trader, of course, should be a confident one, should have its own merits behind the trade decision. However, you will have preferred trades that say that you have gained a level of confidence that things are stacking up for me. Things are really stacking up. I want to hit this trade. I want to get involved in this trade. So does that suit your level of confidence, and is your risk reflected in that level of confidence? Do I have technical confirmation? And again, what I like to suggest just with this point is that often price action specialists are technical analysis because they believe in efficient market hypothesis that we'll discuss throughout. They could become a pro course. They believe that price action actually embodies all relative news flow in the price, okay, which is a fair assumption. So they can choose then in certain circumstances to ignore fundamentals. My question then, when understanding this question, is, um, if you're a technical analyst, you're ignoring fundamentals. But if you're a fundamental trader, are you, as opposed to likely ignoring fundamentals as well, or the technicals? So you may have a great idea of a fundamental decision that oil prices is going to rise because OPEC, say for example, are limiting the supply. But there may be something technical in the market that is telling you, well, this is not the best price to get long at. Okay. So do incorporate the technical confirmation, of course, as well. What is the trade setup? What is a technical analysis, perhaps, and does it support my current entry price? What is the current market environment? And again, that is quite ambiguous in terms of the amount of tradable assets there are out there. Of course, there is a current risk theme in the global market environment. It's relative to the business cycle, it's relative to recessionary periods and growth or boom periods, of course. It's relative to shorter term periods in terms of current equity performance, and current, in terms of safe haven performance, gold or the Japanese yen or assets like this. What is the current market environment? So let's put that into practice. Okay, let's really ask ourselves the practical questions as we look at the market in front. This is obviously a price action chart. Whether you're a fundamental trader or a technical trader, it doesn't matter. You're trading the same material. So here we have US oil, WTI oil, of course. And the questions that you could ask yourself right here: why have I chosen to trade this market? Why have I chosen to trade WTI oil? Why have I chosen to trade 5-minute charting? Okay, so all relative, guys. Why have I decided to buy this market? Okay, so what's the directional bias there? Am I choosing to become a buyer or a seller, a bull or a bear? Again, it might be relative to the short time period that I'm trading in. Why have I placed my stop loss here? Is that a completely technical decision? Am I simply basing it off a monetary exposure, whether it's £15 or €15, or perhaps just because it's the last corrective low of these candlesticks? Okay, so we can define obviously trade selection. Let's have a look through defining entry strategy yet again. Professional trading strategy involves a well-defined thought process for entering the markets. Okay, for entering the markets, well-defined thought process. You must not simply enter the markets on a whim. So we need to think, why we're doing something. What is the overall context of a trade? So is it a market choice? Technical analysis can support that, of course. Directional bias, price action, market context, fundamental analysis, and price execution. Again, are you getting the best price execution? What is the spread? What is the volatility? Is that accompanied with the correct amount of leverage for your appetite for risk? Again, so we're defining entry strategy with a whole plethora of factors in entering the market. So can you see how different that is to effectively opening up the JFX trading platform and placing a trade in the euro dollar, or this example, the US dollar CAD? There's a lot to it in terms of those best trading decisions that you may make. If they really stack up, you can see how many choices that you have to make. Of course, you could argue, well, this is simply overthinking trade decisions, and that may be the case for some contextual trades or price action trades or completely technical analysis trades. But over the long run, that's the point. As you develop your own professional methodology, you're going to want to incorporate maybe these 7 that we have on board here with the US Canadian dollar. I know we have a Fibonacci retracement there, we have a pullback trade, and we'll see where that price action takes us, of course. So over the long run, over a year's trading, over 2 years trading, you're going to develop more skills, more expertise. You can include those in your overall decision-making skills to develop your overall approach to trading the markets. Again, trade management is key. Okay, so there is simply much more to trading in financial markets than deciding to buy a market, place a stop loss, and a profit target. Okay, the issue of trade management deals with the task at hand. How do you react as a trader when you're in the life of a particular trade? So you're in that journey of the trade. How do you react? How do you manage the position? Professional trading takes a more proactive stance on managing the trade whilst in the position. This will involve moving stop losses to mitigate risk and actually deciding to take profit on a completely discretionary basis. Okay, so because you're gaining more expertise in the market, because you're becoming much more inclined to use your expertise, of course, you should, of course, use it not only to enter the markets, but to know when the markets or certain news flow may affect your asset in question. What are you going to do in that case? Well, you're going to add some discretion to your trading. You're now long oil, it's showing you $200 perhaps, but some news has come out to say, well, there's going to be a huge increase in US fracking over the next 3 months, and there's going to be a new supply entering the markets. Oh, that's going to, of course, increase the supply of oil into the market. Of course, I'm looking to capture what profit I have on board before this market pulls back. That's a totally discretionary choice, of course, because you're reacting to the news flow. Again, we'll walk through a typical example here. So what we have again is the same questionable trade. We have the US dollar CAD, we have our Fibonacci retracement again. If you are more concerned with technical analysis, not to go through in too much context because we have a lot of technical analysis in the later lessons, we define the Fibonacci retracement here as the best risk reward at 61.8%. So if you can just see where I'm annotating that 61%, 61.8% retracement level both here and here. That is because, excuse me, that is because, well, the Fibonacci retracement, it's a Fibonacci retracement. It's looking for the market to pull back before the trend continues, okay? So these other levels, the 50 to 38.2, yes, they're good levels, but this is the best risk reward because we can look to find the full retracement level at 61.8. And then the stop loss is simply below a rough area, technical area below that level, because the signal is technically invalid then when the Fibonacci retracement breaks down. Okay, so let's go back on to trade expectation and exit strategy. The question I would like to pose is, what is your profit expectations on entry? Okay, so what is your profit expectations on entry? Well, the trade expectations must be conformative to your exit strategy. Now, what does that mean? It must be conformative to your exit strategy. It must conclude, it must understand your own idea about what's happening in the market. Okay, so again, we have a few examples here. We have the market trading up. We have, of course, profit. You could take obviously profit here at 125. You could take profit at 250 euros. Again, you're allowing the market to continue to trade at these different levels. At 300 euros is a great profit on one particular trade. But do you believe this is going to go the full way back? And of course, if the market trades up to this level, stalls for a long period and starts to trade to the downside, it's absolutely fine. In fact, it's recommended to take profit, to use discretionary basis to say, well, I may be at 350 euros. Am I really going, is it really the best decision to hold out for an attempt to try and get full profit at 450 euros? Or am I happy with that as a great winner in the markets? I've caught a fantastic trade. I've followed it for quite some time. It showed me fantastic profit. It's a great trade and I accept that. Okay, so again, how likely is it that you're going to make 450 euros in this trade? When you enter the trade, you're unaware of that. We don't know the full answer to the trade, but what we do want to trade is this bounce from the 61.8% retracement level, and then we manage the trade expectation as the trade unfolds. We manage the life of the trade, and this is going to help you to book in more profit, actually, even though you may exit some trades earlier over using your discretionary analysis, of course, and relatively to what the price action is telling you, what the market is telling you at that particular time, you're able to book in much more profit across a wide range of trades. So take that into account, of course, in developing your own methodology. Okay, so let's move on then, and we'll focus then on risk management just with this methodology. Well, the priority of trading in financial markets should be to protect capital whilst looking for the best potential trading opportunities, okay? So we have an account. We want to preserve that account. We don't want to get involved in 10 silly trades, or even one silly trade, or one trade that we don't have a level of conviction with. We want to have a fully funded account ready to make those trades when there's great opportunity that is presented across a wide range of asset classes. We should always be focused on the risks involved in each particular trade and be comfortable accepting those risks. Again, comfort is of huge consequence because we develop a level of objectivity in our trading. Too often the approach of retail traders is, how can I make as much money as possible? This leads many traders to focus on maximizing profits no matter the risk, ignoring the fundamental process of risk management may see short-term overperformance, but is not liable to induce long-term consistent profitability. And we've hit the nail on the head there before we move on to professional principles. What we are looking to develop with the professional methodology here is long-term consistent profitability. And I know that might seem a bit of a reach for some of us, but my colleagues, myself, we've been trading for over 10, 15 years as a career. It's no consequence, of course, that we develop a professional approach or a method that we're able to outperform the markets over such a long period of time, month on month. So that is, of course, possible for each and everyone, but you start from the ground up. You start building your own risk management skills and your own methodology before taking on more risk. And again, you want to focus on long-term consistent profitability, so you're profitable each and every month of the year. Of course, you might have one or two down trends, of course, but the profit is obviously in focusing on consistency. So let's move on then to professional principles, and we'll define, of course, four of the main constants there, with trading with consistency, trading with discipline, exercising patience, and trading with accuracy. Okay, so first with consistency, let us define consistency is the one aspect of your trading approach that will help you navigate the financial markets and effectively keep you in the game. Okay, so here's an example that I have to the right there. This is just a hypothetical number of trades that you may have placed. So 10 trades. Let's look at the market. The first thing I will notice, of course, I don't know, I'll ask the question, what is the first thing that some of our students joining us will notice with this level of trading? Philip says the profit. Okay, that's a fantastic answer. Susan says both winners and losers. Okay, that's certainly the case. The first thing I noticed, to be honest, is that it's diversified. It's a diversified trading experience. So we're not only trading US dollar 10 trades in US dollar currency pairs. We've got a US dollar yen, we've got a forex pair with the dollar ZAR, we've got a pound Swiss, the Aussie New Zealand, we've got the German DAX, an equity index, we've got New Zealand CAD, the Nasdaq 100, which is a US equity index, we've got Brent or UK oil, we have gold, and then we have copper, again, two completely different metals. So diversification is key, of course, in trading different asset classes. That would tell me that they're not only trying to diversify or mitigate risk, but they're looking for opportunities across a wide range of asset classes. So let's say the dollar is quiet at the moment, which, to be honest, is certainly not the case. But if the dollar is experiencing no volatility or volume, then a lot of forex majors are going to be quite quiet, okay, or more likely to be quite quiet. So we'll need to look for opportunities across different asset classes. This trader certainly has done that. Yes, of course, then to answer some of your thoughts, of course the profit is of keen importance. The fact that the guy has accepted 1, 2, 3, 4 losers. Okay, so he's effectively trading well here, and he's effectively had 60 pounds or euros or dollars profit over 10 trades. So that's fantastic. If you're likely to make 20 trades, you're talking $120 or pounds or euros. So that's fantastic. You know that if he's developing this over a long period of time, perhaps this is only over 2 days or 3 days, perhaps, that will be very, very profitable indeed for the trader. The second thing that I'll note as well, just in terms of consistency, is that this trader is, of course, assertively accepting risk and is taking losers. The ability to take losers is key. So we see 4 losers here, of course. One thing that isn't great about this account is, of course, the biggest trade is, of course, a loser, effectively an $18 euro or pound loser, and it's actually outweighing his biggest winner of 14. Okay, so that's not a great point, but again, look, there's risks involved, and maybe this was his high conviction trade and something happened in the market. Okay, but let's move on. And you can see how this portfolio brings into context all of these levels of consistency through trading. It involves accepting and taking losing traders, of course it does. Working on trading consistency will focus on developing a level of performance that leads to profit. Okay, so there's a very important point. Developing a level of performance that leads to profit. So let's forget about profit for a moment. Let's develop a level of performance. Naturalistically, you will think, of course, over the long term, profit will be the end result of that equation. And once traders accomplish a level of consistency, the probability of them becoming a long-term successful trader greatly increases. So again, if we're in the business of assessing probability as traders, why don't we assess our own probability? I mean, is that a little ironic, of course, but we should assess our own probability. Giving ourselves a competitive advantage in terms of focusing on consistency will make us a better trader.